of State Legislators. I will be serving as the moderator of today's webinar. Next slide. As a reminder, if at any time during this webinar you have any difficulty hearing the audio through your computer speakers, please use your telephone to dial in to hear the audio portion. Next slide. The National Conference of State Legislators is pleased to partner with the Pew Charitable Trust to bring you this webinar. In case you are not familiar with NCSL, we are a bipartisan organization that serves the legislators and staffs of the nation's 50 states, its commonwealths, and territories. NCSL provides a number of different services, including research, testimony, and opportunities for lawmakers to exchange ideas on pressing state policy issues. Next slide. The subject of budget reserve investment policy falls within the jurisdiction of one of NCSL's 8 standing committees, Budgets and Revenue. These standing committees provide a forum for the exchange of ideas as well as a framework for legislators to create formal public policy positions for NCSL. The committees meet twice a year at the NCSL Legislative Summit and the NCSL Capitol Forum. For more information on these meetings or NCSL's activities and services to legislators and legislative staff, please visit our website at www.ncsl.org. Next slide. The purpose of this jointly sponsored webinar is to discuss new research conducted by the Pew Charitable Trusts and examine state efforts to seek higher yield investments for their budget reserves without taking on undue fiscal risk. With interest rates at prolonged historic lows, legislators in many states have expressed interest in boosting yields on reserve balances. This session will discuss some of the restrictions states face in investing reserve funds, as well as how fund managers balance the need for both safety and liquidity against the possibility of higher yield. While day-to-day management of these portfolios is typically an executive branch function, legislators play a key role authorizing or prohibiting investment vehicles, legislating fund management and oversight structures, as well as providing guidance on investment policy parameters. Next slide. Today's webinar features 3 presentations. The first presentation will provide an overview of state efforts to balance fiscal prudence with higher yield budget reserve investments and highlight findings from recent Pew research. This discussion will be followed by a presentation from the point of view of a Texas state legislator and a municipal market analyst. Each of them will share different state experiences and perspectives. At this time, all participants are in listen-only mode. At the end of the formal presentation, we will open up the discussion to include questions from the audience. However, you can submit a question at any time by clicking on the control panel on the right side of your screen. Once you do so, enter your query on the questions box. Your question will not be visible to everyone, only to webinar administrators. We will take as many questions as possible within the time frame we have available. As a reminder, this conference is being recorded, and the information highlighted today, along with additional resources, will be available through both the NCSL and Pew websites. Next slide. Our first speaker, Akshay Iyengar, is an associate with the State Fiscal Health Group at the Pew Charitable Trusts and the primary author of a recently published issue brief, State Budget Strategies, Investment Policy to Preserve Fiscal Flexibility. He previously worked at Avalier Health LLC, Chamber Hill Strategies, and as a survey researcher at the University of Missouri St. Louis and the City of St. Louis Department of Health. He holds degrees from Georgetown University and Washington University in St. Louis. Next slide. Our second presenter will be Representative Giovanni Capriglione from Texas. Representative Capriglione was elected to the Texas House of Representatives in 2012 and is serving a second term representing District 96. Currently serves on several committees, including Appropriations, Local and Consent, and Investments and Financial Services, where he serves as the chair of the Bond Indebtedness Subcommittee. Representative Capriglione is now the owner and president of his own small business, Texas Adventure Capital LLC, where he provides business services to various investment fund managers and business owners. Prior to that, he was a senior vice president at an investment firm where he managed the loan and equity portfolios of various American businesses. Next slide. Our third and final speaker will be Matt Fabian, a partner at Municipal Markets Analytics, where he leads market and credit research. Mr. Fabian is the lead contributor for MMA's weekly outlook and biweekly default trends. His expansive knowledge of the idiosyncratic characteristics of the municipal market has made him one of the primary voices of the industry. He is routinely a featured speaker at numerous industry conferences on a wide range of topics, including investment strategy, demographic trends, bond insurance, tax reform, derivatives, defaults, state governments, and municipal credit. We look forward to hearing from all 3 of our distinguished speakers and thank them for agreeing to participate in this session today. Next slide. Now I will turn the program over to Brenna Erford, Manager for the Pew Charitable Trust State Fiscal and Economic Growth Project, who has a few words regarding their State Budget Strategy Series. Welcome, Brenna.
Thank you, Jackson, and thank you everyone who's joined us today for this webinar. Thanks also to our panelists. This should be an interesting discussion. The Pew Brief we'll discuss today is the first in a series about state budget strategies, highlighting approaches and tools that state policymakers can utilize to improve the fiscal health and stability of state budgets. We'll be launching our next brief on budget estimate assumptions in late June. So speaking today will be my colleague Akshay Iyengar, and who is also the lead writer for this brief. Akshay will go into the major findings of this publication and also provide some examples illustrating its key points. So without further ado, Akshay.
Thank you, Brenna. While states typically invest rainy day fund holdings and other operating fund balances in low-risk, short-term assets, some states are experimenting with a different approach. As Jackson mentioned, with interest rates at historic lows, a few states like Texas are looking to move some of their holdings into long-term, higher-risk assets. In this webinar, we'll discuss why states are making this shift, and we'll explore some of the benefits and pitfalls. Let's first take a look at how rainy day funds fit within states' broader fiscal framework. States divide their finances across a variety of accounts, some long-term, some short-term, things like general funds, education funds, Medicaid funds, and other accounts for current expenditures can be considered to be states' operating funds. Separately, states manage a number of non-operating funds, which are often long-term trusts or investment accounts, such as pension funds, sovereign wealth funds, and land trusts. Investment returns are a major focus for these accounts. They're larger players in the market, and they can shoulder heavier risk given their longer time horizons and larger balances. But this is very different from operating funds, for which investment returns have historically been a fairly minor concern. I highlight operating funds when I zoom in on rainy day funds because it's important to emphasize that rainy day fund balances aim to bolster operating funds. Rainy day funds serve as states' general purpose savings accounts, and they hold money to deal with unexpected shortfalls, recessions, and other emergencies. And together with other idle cash resources such as ending balances and operating funds and other dedicated savings accounts, these collectively form states' reserves. In most states, overall reserve balances and other idle cash resources are pooled together in short-term investment pools, which have fairly clear management objectives. And for short-term pools, those objectives are safety before liquidity before yield. States need the principal on their investments to remain safe, particularly from market fluctuations, and they also need their money to remain liquid so that they can access it quickly without incurring big losses. All this means that yields or returns have traditionally been a very low priority for these pools. The focus on safety and liquidity does constrain states' investment options. Another factor, however, are legal restrictions, which I'll touch on briefly. Specifically, state law often imposes limits on the kinds of investments state officials can make. This includes authorizing only certain asset types or limiting maturities. In Indiana, for example, cash that's managed by the state treasurer can only be invested in securities guaranteed by the full faith and credit of the U.S. government, meaning they can only invest in U.S. treasuries, other government bonds, or securities issued by government-sponsored entities like Fannie Mae and Freddie Mac. Maturities for 75% of this portfolio must remain under 2 years, and the remaining 25% cannot exceed 5 years. Beyond that, states may want to take into account yield restriction rules against what is known as arbitrage. IRS rules, for example, can deny tax-exempt status for municipal bonds if the proceeds of a bond sale or an equivalent amount of same-source dollars are invested in higher-yielding securities. In Arizona, for example, although state law permits the rainy day fund to invest in equities or stocks, the state treasurer's office has never done so. This is likely in part due to concerns about safety and liquidity, but in conversations with the state, Pew was told that the tax-exempt status for outstanding state-issued municipal debt acted as an additional disincentive. Because the balance in the state's rainy day fund is less than the value of the bond issuance, and because both are financed by general revenue, there's concern that higher returns for rainy day fund investments would jeopardize the tax-exempt status of the state's outstanding bonds. Mr. Fabian will touch on this issue and other considerations from a market perspective in a little bit. But in the meantime, let's now take a more detailed look at how safety and liquidity concerns affect investment choices for these kinds of short-term pools. This chart shows different types of debt in terms of safety or risk on the vertical axis and in terms of liquidity or time horizon on the horizontal axis. Riskier assets like equities or stocks, or alternative investments like private equity, hedge funds, commodities, and real estate hold greater risk despite offering higher potential returns. These have in recent years taken on a larger role in long-term accounts like pension funds, something that Pew's pensions team has written quite a bit about, but they play a much lesser role in short-term pools. Instead, investments for rainy day fund balances typically sit at the lower left. These are short-term fixed income securities or cash equivalents with guaranteed rates of return and short maturities that ensure safety and liquidity. Examples include things like certificates of deposit, commercial paper, and short-term U.S. Treasury bills or T-bills. Other low-risk assets include things like agency bonds or debt issued by public agencies or government-sponsored entities. Even so, some funds, as we'll soon describe, have invested in riskier assets than what is circled. And in practice, there's something of a continuum between a long-term savings account and a short-term savings account. The question policymakers have to ask is, what is the purpose for their rainy day fund? In other words, how and when do policymakers expect to use the fund? Is a rainy day fund an emergency savings account, one which policymakers can access as quickly as possible, or is it a longer-term insurance account that can balance greater risk? Ultimately, the optimal investment strategy will depend on this definition. As an illustration of how investment strategy can differ across fund type, let's take a look at North Dakota. While North Dakota has a traditional rainy day fund, the Budget Stabilization Fund, it also puts a lot of its oil and gas revenues in a longer-term trust they call the Legacy Fund. In June 2015, balances in this fund were more than 80% held in short-term fixed income, with the remainder held largely in Bank of North Dakota certificates of deposit. For the Legacy Fund, by contrast, 50% of the balance was held in domestic or international equities. And if you look at year-over-year returns, the Legacy Fund's one-year return during fiscal year 2015 was 3.3% compared to just 1.9% for the Budget Stabilization Fund. So this illustrates how a longer-term reserve can shoulder greater risk and earn potentially higher returns than a short-term traditional rainy day fund. Now, while North Dakota has carved out a separate long-term account for some of its oil revenues in the form of the Legacy Fund, in other states, even traditional rainy day funds and other short-term pools are being driven towards riskier holdings. Two key factors are at play. First, interest rates remain at record lows. What we display here is the secondary market rate for 3-month U.S. Treasury bills, and these are a very common holding in short-term pools. You can see that even prior to the last recession, rates of return were about 5%. Since the Great Recession, however, returns have been even lower, and we can see that even more clearly when we zoom in. This figure illustrates that yields on 3-month Treasuries have been near zero since 2009, and the going assumption is that these rates are not going to climb much higher in the foreseeable future. Rates on other short-term, low-risk assets aren't a whole lot better, and this has been driving some fund managers and policymakers towards riskier holdings in order to obtain better returns. We'll discuss shortly how concerns about interest rates affected Texas's rainy day fund reforms, but let me bring up first Alaska to highlight the other major factor that's driving riskier investments, and that's oil and natural gas prices. While progress for building rainy day funds remains uneven, some states saw their balances swell in recent years because of big revenue collections from extractive industry, something we saw with North Dakota and which we'll see in Texas as well. But even with the recent fall in energy prices, many of these states now have reserve balances that well exceed their expected short-term needs. And that's driven experiments with riskier holdings. Looking at Alaska, their main rainy day fund, fueled by oil revenues, grew to approximately $13 billion by fiscal year 2015, which made it at the time the largest in the country. Since 2000, a chunk of that balance, or about $6.7 billion in fiscal 2014, was placed in a sub-account that could invest in equity securities. And you can see in this chart the growth of both the main account and sub-account in terms of market value. Overall, between 2006 and 2014, returns for the sub-account averaged about 7% compared to 3.8% for the main account. You might notice, however, that the subaccount disappears in 2015, and that's because when oil prices fell, the state treasurer there could no longer guarantee that rainy day fund balances would not be needed within a 5-year window. And so because of these liquidity concerns, the subaccount was liquidated and most of the equity holdings were sold at a loss. If we look at year-over-year returns, you can see how the returns on the subaccount's investments were much more volatile than the main accounts, tracking the stock market. The subaccount suffered severe losses in 2009, for example, but enjoyed a 20% gain in 2011. But because the broader state economy grew volatile, the holdings had to be sold at an inopportune time. And this example, therefore, illustrates both potential gains, but also some of the risks that come with a longer-term approach to what remains a short-term fund. Texas offers a slightly different story, and one that may be a little bit more generalizable given Texas's broader economics. Like Alaska, Texas's rainy day fund is also fueled by oil and gas revenue deposits, and it has grown quite large. It currently sits at over $9 billion. Low returns on the fund's investments encouraged legislators and the Comptroller's office in recent years to look into a more diverse portfolio. Representative Capriglione will speak soon in greater detail on the subject, but as a result of legislation that passed last year, the fund now includes assets with a range of maturities. A quarter of the balance now sits in assets that have maturities greater than 3 years. And the portfolio also includes some holdings with higher potential returns than government debt. This includes things like corporate debt and some investments in alternatives like asset and mortgage-backed securities. This is an interesting effort, and it touches on some of the challenges that other states also face, not just for rainy day funds, but for other idle reserve funds and idle cash pools. I'm sure our audience is looking forward to hearing more, as well as learning about how legislators especially can contribute to these debates. And so with that, let me turn things over to Representative Capriglione.
Great. Thank you, Akshay. I appreciate that. And thank you to everybody on the call. My name is Giovanni Capriglione, and I'm the Texas State Representative in Northeast Tarrant County. I was the author of the bill that created the Texas Enterprise Stabilization Fund investment opportunity. And what I wanted to start with was kind of what the genesis of this, why did we want to go down this path? And in Texas, our state has seen its rainy day fund just continue to climb year over year over the last almost over a decade. But at the same time, legislators, including myself, we've set a really high bar for use of these dollars. So the common sense question that we've been asked is, okay, are we serving the taxpayers well by holding on to such a large fund, but at the same time watching the corpus lose its value every day due to inflation? The way that treasuries have been recently, obviously the rate of inflation is higher than that, and so we can say that we're maintaining the principle and that we're holding a secure fund, but the reality is that inflation continues to lower its value. So if we go on to the next slide, what I wanted to talk about was, I guess, the first version of this. A different representative had attempted to pass this bill in the first, I guess it was the 83rd session. What I wanted to do is talk about maybe some of the issues we faced regarding passage of the bill then, so that it's something to think about in other states if you wanted to try and do something similar. One of the big issues really had very little to do with the rainy day fund or investments. It was, we had just come off a tough session, a tough budget session in the previous that just really affected, I guess, people's risk aversion to making any sorts of investments or not paying or just being resistant to making those investments. The other thing was that in that session, we had a lot of infrastructure needs. And we were talking about using possibly the rainy day fund for other purposes, such as transportation, or what a big item for us was at that time was water-related investments. Those are expensive, big investments, and so we were having that conversation at that time, what to do with it. So that obviously played a role, which of course also comes out to what else can we do besides invest these dollars. At the time, we had, I think, approximately $7 billion in our rainy day fund. So the conversation was about, okay, should we invest, put some of this money in general revenue and fund education? Should we, pay down some of our long-term debt? Should we use these dollars maybe as part of a tax cut in the state? So as you can imagine, as these issues came popping up, you started to lose support. But one of the bigger items that should always be something that consider is what would be the legislative oversight of these investments. As Akshay mentioned, generally speaking, this is something that's done in the comptroller's office or the executive branch, maybe a treasurer's office. And of course, the legislature wanted to make sure that they had oversight and restrictions on them. And when that bill was first introduced, that was not, some of those items were not taken into account when the bill was actually being discussed. And so those concerns were definitely there. As part of that bill, version 1 of the bill, we had put a fixed amount. At the time, it was 30%. And that turned out not to be something acceptable to most legislators, because the question was, well, what if, we start pulling down on the rainy day fund and 30% doesn't make sense anymore? Maybe that's too much, or maybe that's too little. So there wasn't that flexibility. And of course, we were concerned about liquidity and potential loss of principal. In Texas, a few years before that, we had a major hurricane hit. We had had some really large wildfires that cost the state significant dollars to put in. And so when people, when the original Economic Stabilization Fund, or Rainy Day Fund, was created, it was to do that, to take care of blips in the economic cycle and if revenues weren't coming in. But what it's developed is, okay, can we use it in case of an emergency, like besides financial, but weather-related or so on? And when most legislators were thinking about liquidity, what they were concerned about was, let's say we had to take this money out in case of an emergency, could we take it out quickly? And there were also, questions about the manager. How would we choose the manager or managers of this? How much of those dollars would they have access to? Were there potential conflicts of interest in choosing those managers? So when that bill was first put out, although I think we got it out of the House, it didn't go much further because of those concerns. So if we go to the next slide, I took a lot of those concerns, and as well as did the new comptroller, who I worked with really closely on this, both on setting the policy, but also in making the bill. And so what we learned, we applied to this bill. So, at that time, I guess if you want to look at it from a different environment, our rainy day fund had grown. It was expected to grow. And we were now at the point where we had more in our rainy day fund than ever before. In fact, we were more concerned in the last session about when or if we were going to hit our constitutional limit than we were about necessarily risk to the investments that might be inside of it. Our budget last session, which was at the time that oil was at around $60 a barrel, still looked very good, looked very solid. And so we weren't as concerned. In fact, our projected revenues for the budget cycle ended up expected to be higher than what we thought we would spend. So we had some headroom, and so it wasn't deemed as much of a risk. But I think the biggest point that this bill did, which I would, guess have others consider, is that what we did is we created in the prior session something called a sufficient balance. A sufficient balance is a committee made up of members of the legislature who can meet, and they do meet before the next session starts, to come up with what we, the legislature, deems to be a sufficient amount inside of our rainy day fund. What is the low number that we're willing to go and talk about to do that and to put inside of our fund? And that committee takes testimony on projected balance, transfers into the fund, it takes information about and testimony from credit agencies so that we would know what our minimum was. What that sufficient balance does, and tying that rainy day fund to that, what we're saying is we're going to allow the comptroller's office to invest dollars above that sufficient balance. And so the legislature has the ability, even outside of session, in the interim, to raise and lower that amount as we deem prudent. We defined a target yield, and so what we wanted to do is be able to make sure that we were able to at least hit our inflation purchasing power parity, rather. And we added some additional investment policy rules. Working with the comptroller, we started to define what the diversification amounts should be, what the due diligence would be, what the reporting requirements, what the audits of that were. And anyway, putting all of that together ended up allowing that bill to pass nearly unanimously in both the House and the Senate, and finally for the governor for his signature. So if I go to the last slide here, I just wanted to highlight the fact that this fund to date has put in $2.63 billion investments into the fund. It's using a dollar cost averaging technique, so it's been putting those dollars in chunks. And as Akshay showed, it's a wide variety of different investments that we'd be able to put it in. Right now, we just recently got an update from the Comptroller's Office from the Appropriations and our Appropriations Committee hearing, and we're on target. Our funds, our investment funds are doing well, and right now it seems like we're on target. So those are my remarks for now. Be happy to answer any questions after that, but for now, let's please go over to Matt Fabian.
Thank you, Representative. If we go to the next slide, Municipal Market Analytics, just for those of you who don't know, we are an independent research group that we publish market strategy, commentary, and we do some consulting for participants in the municipal bond market. Most every major bond dealer and every major bond buyer we interact with in some way. We don't buy or sell muni bonds or derivatives, or we don't do any trading or underwriting. We are just a pure research firm. So take my comments in that context of we try to be as independent as possible. So I was delighted to speak on the webinar today because it is this is exactly the kind of issue that that states should be considering, and that and that small governments should be thinking about. It's important in general to always remain within a context, and to make sure that that the policies or the policy adjustments that are being undertaken are really well understood and transparent. From the market's perspective, so thinking just about municipal bond investors and the rating agencies and other participants, what we're talking about here is really a very incremental issue when it comes to states, and when we're talking about things like budget stabilization funds and other sort of investment pools, which are really only informally pledged to outstanding bonds or to the payment of bonds. So we're not talking about debt service reserve funds, because things become much more serious when you start talking to investors about changes in your in your strategy for investing, say, a debt service reserve fund or something, or a sinking fund, or something that is specifically tied to a bond series, where you have to have, in some cases 7-day liquidity, or at most 30-day liquidity, where you need to be able to absolutely liquidate those investments and get something very close to par, or at least to market value. And when we talk about local governments, again, it's a different shift. States, for the most part, can raise revenues as they need to, and they can manage their own spending. And in the end, states are only as insolvent as they choose to be, from a credit analyst's perspective. Local governments are very different creatures, right? So they don't necessarily have the ability to raise revenue as they need to. They have generally much thinner budget balance. There is a much less flexibility in how they spend money. So thinking about building in more, here prudence in investing at the local level is much more important. And regardless, anything should be done with very well thought out, very well discussed. I think that our rules, just like the representative just spoke about, right? It was a very deliberative process, and continues to be in Texas. That is sort of the model. To the extent you're going to roll out a new suite of investment policies, everyone has to know that that's what you're doing, and that in that in part you're taking this more aggressive standpoint with respect to the investment. And then and in the end, this is something that all investors are considering at this point. I speak to municipal bond investors all day, every day, pretty much, and everyone is desperate for things to buy. There's no yield really anywhere in the bond market. Every investor is chasing yield, chasing products, and chasing things, and with the hope that for the most part this time it will be different, right? That there won't be a snapback into higher interest rates, or that stock prices won't fall at some point. And I mean, there is something to that, right? Long-term expectations for slow economic growth imply that in general things are going to stay fairly tight, and that in general that there won't be much yield in the market or in many products going forward for the foreseeable future. So it is good to think about what are your options if you're moving into a long-term, low-return world. Do you want to invest the same way that you always have? Okay, so let's go to the next slide. The risks, right? So specifically, just to talk quickly about the federal arbitrage restrictions, because this has come up, and I've consulted a number of tax attorneys and people in the Treasury Department to think about what are specifically the risks. For the most part, right, when you talk about arbitrage restrictions with respect to tax-exempt bond proceeds are with respect to the investment of actual bond proceeds. So bond proceeds can't be put into an investment account that will generate more return than what the bond rate is. Otherwise, you have to rebate the difference to the IRS. But there's also an area called replacement proceeds, and so here it is money that is specifically tied or connected to a bond issue. So it goes and regardless of where the money comes from, to the extent it is explicitly pledged to a bond series or to a bond program, there are restrictions there too, where the investment of that money can exceed the ultimate bond rate. But it is a pretty difficult test, right? Think about the Texas PSF, which explicitly backs bond series all across the state, and yet they're allowed to invest and do invest in products well above the bond rate. So there needs to be a so think sinking fund, or think some other kind of specific pledged fund, where in theory it may be something like a budget reserve fund, but if there's a specific language in there says that this can also be 50% of this money can be used specifically to pay off these bonds specifically. That's the kind of nexus that the IRS would look at to worry about. So, but general budget stabilization funds should, regardless of their size, should be, always consult your tax attorney. But this should be the kind of thing that you can invest more aggressively in. Okay, just to talk quickly, because I've been talking a little bit too much here. When credit analysts like myself or the rating agencies come at a budget stabilization fund, to the extent portion of it is invested more aggressively, we will tend to discount it. So if 10 or 15% of the budget fund is invested in equities or hedge funds or similar, we'll just assume that the remaining 90 or 85% of the fund is the actual budget stabilization fund, and the rest is sort of an investment account, that can't necessarily be relied upon. So to the extent your rating depends on the budget stabilization fund, you have to tread carefully with that. And from your own internal purposes, you do have risk of loss, you have risk of default, and similar. A bigger risk may be the risk of liquidity, and that if you need to raise money in a hurry, to the extent the money is invested in something more aggressively, it may be difficult or impossible to extract your money within a timely manner at something close to your current statement value or certainly par. So again, this should be a section of the fund that you're investing that you don't necessarily need for immediate budget stabilization. And we've had a history of problems in my business in the municipal industry. Orange County being the biggest with reckless investment. That was Orange County was borrowing money to bet on interest rates in an extremely illiquid way. and when things started to fall apart, it caused massive problems for their local investment pool. And other governments, had made similar, strategies, not as big. But so the analyst community in the municipal bond market does think more about this than you might think. I mean, for sure, with current credit spreads so tight, and with a highly permissive lending environment, maybe the most permissive lending environment that we've seen in modern history right now, as of today, there is going to be less financial penalty paid. It doesn't mean necessarily, though, that it's a great thing for you to be doing long term. So you need to be considerate of that. And then finally, just remember that to the extent this is a budget stabilization fund, right? So you are putting money into a fund with the hope that when the economy has a turn down, you can tap that money to keep to keep taxes low or spending high. But if you're invested in equities or something with an economic sensitivity, just when the economy turns down and your revenues soften, at the same time the value of those investments will fall. So there's an element of pro-cyclicality that could make it less reliable in times of economic stress. So with that, I will turn it back to Jackson. Thanks very much for enduring my ramble.
Great. Thanks all. Now that we have heard from all of our presenters, we're happy to take some questions. Again, to ask a question, please type it into the Q&A box in the right-hand corner of your screen. We've got one for Representative Capriglione. Can you tell us about how involved the Comptroller's Office was with the development of the Rainy Day Fund investment bill?
Sure. Thanks for the question. The Comptroller was, I would say, very involved in this bill. Between the first version and the second version, we actually had a second Comptroller, and ultimately this was going to be something that they were managing it. So they helped my office and other members talk about what it meant. But I would say that the part that they were really focused on and they helped us with was on tying it to the sufficient balance. The Comptroller, kind of as Matt had talked about, also knows what it takes to certify the budget and what some of the credit agencies had wanted, and they didn't want to trip some of those levers that might come up. And so we probably spend a lot of time with them during the session, and I think that was important because I wanted to make sure that we both agreed on who was doing what when it came to these investments.
Great. And another one for you. How much oversight do legislators or relevant committees exercise over the investments of public funds?
So in this particular case, what we have in Texas, we have a broad kind of definition, or several different definitions about what type of investments and that any of our fund managers or private fund managers have to subscribe to, and it's everything from not these types of businesses, or focus on this companies that do this, or bonds that do this, and we even have countries that we won't allow investments in. Drilling down a little bit further, we talk about the prudent investment decisions and the definitions for that, so that we can describe the fiduciary responsibilities of the investors, the fund managers, which in this case was our Comptroller's Office. And I would say the biggest part of that, though, is our select committee on the sufficient balance definitions, because they ultimately, depending on what they choose for the sufficient balance, can decide whether there's any investment or no investment at all. And as part of this, we were really focused on transparency as well. That's why we've already had at least one hearing so far that included where we were on this process, but also all the audits, the reporting, and so on. So the legislature has played quite a big of a role in defining what the terms of this fund would be.
Great, thank you. One for Mr. Fabian. How has volatility in the energy market affected investor appetite?
Well, to the extent, energy has been a it's been a real signal that that inflationary pressures are weak, and that economic activity, may not be as robust as expected. There's a real push. Yesterday the German 10-year bond went negative again, and it has lit off a number of discussions across the financial markets about negative bond yields in the United States, in across the world, and sort of what the implications are. But when we think about the discussion of a negative bond yield, what that is you are, as an investor, you are paying an issuer, say, $5 in expectation of receiving $4 later, and because you're betting that $4 later will be worth more than your $5 today. So it's a straight bet on deflation, right? And that economic activity is anything but robust. So there's been a real transition in our market in the last few days, and maybe this is just something ahead of the Brexit vote later this month. Maybe it's all about the Fed today. Who knows? But it is a very very conservative market right now. But in general, energy volatility, less than chasing people away from yield or speculative investments like you might think, has really amplified, if anything, the quest for yield. And I've had two major investment managers in the muni space this week tell me that they believe that there is zero risk premium available anywhere in the market, meaning you are not getting paid to invest in anything with any kind of risk at this point. Bonds are uniformly expensive. It's a pretty compelling statement.
Great, thank you. Here's one for Akshay. Does Pew collect info or have reports on state rainy day fund balances compared to state budget appropriations, or an overview of state rainy day fund investments by type for each state?
So we have collected usage data for all 50 states for fiscal year 2014. This is not going to be an ongoing collection, but we will explore this data in some upcoming reports. I'll also point you to our fiscal 50 indicator online, and in that we have a reserves and balances indicator which shows rainy day funds and reserve balances, rainy day funds plus ending balances mostly from NASBO data as a percentage of general fund expenditures across all 50 states. On the subject of state investments, we do not have a 50-state, we do not have any 50-state analyses of rainy day fund investments at this time.
Great, thank you. And another question for Representative Capriglione. Are other short-term investment pools moving towards riskier investments?
In the state, not yet, not a substantial amount, but I am interested in looking at that. We have, the rainy day is obviously our largest fund in one place. However, we have reserves all across the state, whether that's our community colleges or some of our larger municipalities, counties, and so forth. They do have quite a large reserve. And what we've done at the state is, prior to this, we had said, all right, everybody invests in treasuries. So now that the state has said, okay, we're willing to go a little bit more aggressively in investing, and then some of those community colleges and municipalities have contacted us and said, we would like that opportunity as well. So I think that's something we'll definitely have a conversation in the next session in terms of that. But that would be something we'd have to spend a little bit more time, a little bit more care looking at.
Great, thank you. And this one appears to be for Mr. Fabian. How can a state determine an appropriate size for their fund?
For their reserve funds, here,
yes.
I think that the guidance from Pew, to this point has been wonderful, and Pew basically makes the connection between the volatility of your revenues and ultimately the flexibility of your budget and the size of our reserves. You don't. It would also, I would say, go to the level of political flexibility that is in the state. You want to look at to what extent your revenues can provide an unexpected downside surprise, and then how much flexibility you have in the budget away from that. So if your revenues are say relying on capital gains or other more volatile sources, and they can drop 10% in a year, what exactly do you have to patch that gap? That's not, you'd want to limit your use of mid-year budget gimmicks and other sort of tools that are, long-term more expensive. So having a budget stabilization fund for that purpose, I think, is a fantastic solution. Pew's work has been just wonderful in this respect. So I'd say read the research that these guys have put out and have them call you and talk.
Great. Thank you. Looks like one more. What steps can states take to reduce risk if they want to invest their rainy day funds in higher yield assets? I think this is for Mr. Fabian.
Sure. Although, I think that the representative also could probably take a stab at this with the practice that he's had. I think that, we have to think about first the kind of risk that you're talking about, right? So there's principal risk in that, the things that you buy may default or may lose, may irretrievably lose value, and so you just lose a portion of that money. There are liquidity risks, right, that you don't, so that when you want to go sell it, either you can't sell it because it's tied up with a hedge fund which doesn't give you your money back in a timely way, or selling it would cause you to lose, say, 20 or 30% of the value because it's a much less liquid instrument. 20 or 30% of the value versus what your statement, your brokerage statement says that you have in it. And then there's also the political risk of, what if something goes wrong? Who is going to be to blame? And has the process been transparent and open enough and, frankly, diversely supported enough so that, that the fingers aren't pointed at you specifically if problems happen? Because things will happen, right? Investing in more speculative investments means you're taking on a degree of speculation, and you have to be prepared for that level of downside surprise. So, for me personally, I would think that you want to invest in companies or strategies or asset classes that are as little correlated to the local area and your region as possible. Again, to sort of reduce that pro-cyclicality, so that, if you're investing entirely in China, well, China's maybe a bad example, but because, in a market like this, everything is much more correlated than it ever has been before. So you have to work a little bit harder to make sure that, if your income tax revenues are down in say the third quarter, that the investments in this rainy day fund aren't down too for the same reason. So look for non-correlated assets, and that's probably, and then, when you speak with your investment advisor, talk about what you're trying to maximize. Is it asset preservation, meaning that the money will always be there, as sort of secondary to sort of the added income that you're trying to get? But think about, is it asset preservation? Is it are you trying to match again some other kind of liability? And specifically, what are you after? And there are products to tailor, but in general, as you move out the spectrum and with more correlation in the markets, it just the most important thing is that everyone knows what everyone else is doing, so that if trouble happens, it becomes a problem but not a firestorm.
Great, thank you. Well, this brings us to the conclusion of this webinar. NCSL would again like to thank our presenters for sharing their expertise with us today. If you have any questions following this event, please feel free to contact Akshay Iyengar from the Pew Charitable Trust or myself, Jackson Brainerd from NCSL. Our contact information is listed on the screen. Next slide. As a reminder, this webinar is being recorded and will be archived on the NCSL website. The information highlighted today, along with additional resources, is available through both the NCSL and Pew websites. Next slide. And lastly, please take a moment to share your feedback on this webinar by taking a short survey at the link listed on the screen. Thank you very much for your interest and participation today.